Our next guest says there's nothing the Fed can do to make things better. Joining us now is former Dallas Fed chief economist Michael Cox. And Michael, I'll tell you, after 2 rounds of QE plus the initial Operation Twist, things seem to be getting worse, not better. To your outlook, how would you rate the job Bernanke's done thus far?
Well, it's not very good. It's not all his fault, of course, though. Its monetary policy has done about all it can do to get this economy on track. The real problem now, and it has been all along, is fiscal policy. We have a huge, terribly set of incentives coming out of this administration. They don't seem to understand that firms create jobs when they have a profit incentive to do so. They don't have that when they're going to impose all kinds of government-mandated health care on them, slap a whole bunch of new rules and regulations on them, and also tax them to the hilt, 40%. Now, the United States has the world's highest corporate income tax rate. So what is it about government policy which would cause anybody to expect anything other than bad numbers out of this economy?
Yeah, it's a good point. So you raised the issue about fiscal policy. It's likely to come up in the press conference here this afternoon. Do you think the administration will be listening? Can Bernanke send a strong enough message that we need to sort this out?
Well, if they can, but monetary policy right now is done. You know, you've got interest rates down to historic lows. Interest rates are lower than they have been since the Great Depression. And so we're in a liquidity trap as far as monetary policies goes. There's nowhere to go but up for interest rates. So people don't want to invest, and they'll have a capital loss. They're just hoarding huge masses of M2. Money demand is growing faster than money supply. So now, and that's as the money comes in from Greece, and it's just looking for a safe haven with all this default risk and stuff. So essentially, the Fed has got us in a classic liquidity trap. But again, I want to point to the fact that, you know, there's much we can do. It's just you can't keep using the Fed as a whipping boy for everything that's going wrong. You got to point the finger, look in the mirror, and point the finger. It's at yourself. It's your fiscal policy.
No, absolutely,
so, you know,
Michael.
Obama needs to meet with himself.
When we look at these numbers, though, I mean, you look at the projection for GDP for all of 2012, they took it down from 2.7% growth to 2.2% growth. I mean, that's a big decline, a half a percentage point. At this point, though, isn't even that still ambitious?
Well, it is. The population is growing at 1.5% a year. Labor force is growing, and so if you look at the growth in the economy relative to the growth in the number of people, you basically have a flat per capita GDP economy. So we could be entering some mildly negative numbers in terms of growth in per capita personal income.
Yeah. All right, Michael, hang with us. Michael Cox, our guest, as we walk up to the Federal Reserve Chairman's press conference here. We're going to chat with you more on the other side of the break.
All right, as we wait, let's bring back Michael Cox, former chief economist of the Dallas Federal Reserve. Let me talk to you about the inflation projection here, because they trimmed that as well. They had thought for the full year it would be 2%. Now we're looking at 1.5%. I'm not sure that's good news. I mean, that makes it feel like there's more stalling out there in the economy. Maybe we need a little inflation at this point to get things rolling. What's your take?
I completely agree. I think the Fed wants more inflation than they're getting. I believe they want inflation in the range of 4 to 6%. You'll never hear them say that.
Wow.
But everybody knows that a little bit of inflation is a cure to a lot of recession. That's what the history shows, all the way back to the Great Depression. We had about 3.8% inflation on average from 1913 to today. And if you look back at historically what happened to the business cycle, after that, the business cycle's calmed down. I don't think the Fed's been able to achieve what they wanted, despite the fact they've tried. And the reason is because money demand is growing so fast now relative to money supply. As these interest rates are low, so people are saying, what's the point of putting my money in stocks? I'll just park them in a savings account. And also the money is coming in from the Greek debacle. So the money demand is growing faster than money supply, and that's what's holding inflation down.
This whole palette of numbers that they put out this afternoon, I think is really worrisome. I mean, isn't this worse than what you thought we were going to see today?
No, it's not. And I actually don't think it's worse than what most people thought we were going to see today. The business leaders I talked to were not expecting good news. Nobody's expecting good news until we get some change. Something happens to make things better. There's no reason for things to get better based on these economic policies. So I think that November 6th is probably the most important day in American history.
You are
the
tough.
election.
He's tough.
Michael, less than 2 minutes before the Fed chief speaks, let's see if we can get at least one more comment from you. The FOMC timing of policy firming, you have more members now saying pushing it out to 2014, 2015 is the best bet. What's your take on that? I mean, are we just going to print our way out of this economic doldrum?
If we could, we would, but we can't do that. I mean, everybody knows that money is not a cure for hard times. Inflation just makes things worse. We need a little bit of inflation right now because as the inflation rate goes up, the real estate prices will rise even faster. That'll come in and undershore the values of things out there. The value of real estate will start to rise. And that will be good for the economy because that's where a lot of the softness has been, is in the property market and so on. That will help to build people's wealth a little bit on the real estate side. And then the interest rates will start to rise to reflect inflation expectations. And after the interest rate starts to rise, you'll see we'll get out of the liquidity trap. Banks will start lending again. So I think part of the solution to this problem, a big part of it, is some inflation. Not a lot, because too much inflation is certainly bad for the economy. But we know deflation is bad too. And low inflation is a sign of weakness. We need 4 to 6% inflation for 2 to 3 years.
Let me come in here then and suggest to you what's the best way politically to stoke inflation.
Well, we got to go back to another QE. We had QE1, QE2. It's the only way to do it now is QE3.
All right, we've got Ben Bernanke approaching the podium. Let's listen as he begins the press conference. Michael Cox, thanks to you.
Good afternoon.